Welcome back to another episode. I'm Joshua Roberts, attorney at law, and you're watching Lawyer Up. So I want to thank you guys for tuning in. This channel has grown phenomenally in the first 2 weeks that we've been doing this. We were talking about doing a $50 Amazon giveaway when we reached 500 subscribers. We figured that'd come in the first 3 or 4 months, but it looks like it's coming immediately. So we're going to do the giveaway now. All you need to do is comment below any of the videos the word giveaway and you'll be qualified. Now, young people, you can tune out for a second. Okay, old people, like my age, you have to log in. I've gotten several comments on Facebook that you can't subscribe, or you can't comment, or you can't like things on YouTube. You have to log in. YouTube has to know who you are before you can interact with it. So if you log in, you can use your YouTube login, you can use your Google login. And if you don't remember your username or your password, you can go through the password retrieval process where it'll send it to your email. But the bottom line is you gotta log in so that you can comment giveaway, like, and subscribe. Now today, we're gonna be talking about the CARES Act. You've heard about this in the stimulus package. This is the Coronavirus Aid, Relief, and Economic Security Act. CARES is the acronym. This is the $2 trillion stimulus package that was passed by Congress a couple of weeks ago. Now, you may have seen my overall stimulus package video, and we talked about all of the components of the CARES Act in that video. However, today, we're going to drill down. We're going to talk about the types of things that can put money in your pocket today. We're going to talk about those stimulus checks you've heard about. We're going to talk about the unemployment benefits that have been expanded. We're going to talk about some tax relief measures that have been put into the bill. And last but not least, we're going to talk for the small business owners about the difference between the PPP loan and the EIDL loan. We'll talk about what those mean and which one is better, because people are confused about which one to apply for when I will clarify that for you at the end of this video. So first and foremost, let's talk about what I'm not going to cover today. I'm not going to be talking about the airline bailout component. I'm not going to be talking about the aids or the loan that goes to big businesses. That's with over 500 employees. I'm not going to be talking about the money that's being poured into research and development in the healthcare industry to try to find a vaccine and to provide the personal protective equipment that our healthcare workers so need. Those are all very important things, and they're all addressed somewhat in my other stimulus package video. But today we're talking about things that can put money in your pocket right now. So the first thing to talk about are those stimulus checks. And you have probably heard a lot about these on the news. These are technically tax rebates. So the government's saying we're giving you back tax dollars that you have paid in prior years. The government claims that 94% of all adult Americans will get some type of a stimulus check. Now that check will be $1,200 for every individual that makes $75,000 a year or less. It's of course $2,400 for a married couple that makes $150,000 or less. If an individual makes between $75,000 a year and $100,000 a year, you will get a check, but it's going to be reduced from the $1,200 amount. And unfortunately, if you make more than $200,000 as a married couple or $100,000 as an individual, you will not be receiving a stimulus check. You will also get $500 per kid, which is a nice bonus. Now, as you may have found out, the direct deposit people, the people who file tax returns with their banking information on the returns, they are getting their stimulus money first. People who haven't provided the government with direct deposit information are going to get written checks. And of course, that's going to take longer. A direct deposit is simply a quick transaction where you're moving money from one account to another account electronically. The paper check process, well, the check has to be printed, then it has to be put in an envelope, and then it has to be mailed, and then a mail carrier has to bring it to you. So obviously that's going to take a little bit longer. Now there are government websites where you can log on and you can enter your banking information to hopefully move you out of the stack of people that are going to get a check in the mail and into the stack of people that are going to get the more immediate direct deposit. Category number 2 are your unemployment benefits that have been expanded. Now, I've done a prior video where we talk about all of the details of unemployment benefits, but we're going to hit the highlights in this video. First off, the state unemployment benefits have been expanded. They have expanded who qualifies. In a lot of states, you had to be totally unemployed, no part-time working, to qualify for unemployment. That's not the case anymore. Part-time workers who were working full-time but had their hours cut, now qualify for unemployment benefits. Now, if you're working part-time, of course, your benefits are going to be prorated, but still, it's going to provide you with some unemployment money now. The term, or the amount of time you can be on unemployment, has increased from 26 weeks to 39 weeks, essentially from 6 months to 9 months. And probably the biggest benefit is that the states have received block grants from the federal government, which increase the benefits that the unemployment office can pay. Right now, in my state, Missouri, the most you can get is $320 a week. However, with this stimulus money, the government is paying an extra $600 on top of the $320. So if you are fully unemployed in Missouri, you can receive $920 every week. That's over triple the previous maximum unemployment benefit. Quite incredible. Now, the federal program only goes for 13 weeks, so you can only get the extra $600 for 13 weeks, but that is a significant amount of money. Also, in the CARES Act, they have waived the work search requirement. So you ordinarily have to apply at least 3 different job locations during the week. But under the CARES Act, you don't have to look for work at all. Now, to get into the specifics of how you register, the amount of benefits you will receive, you'll need to take a look at my other video that we put out on unemployment benefits. The third thing that the CARES Act does for you are the tax relief measures. First and foremost, the government is going to allow you to withdraw from your retirement accounts without the 10% penalty. Ordinarily, if you take money out of a retirement account early, there is a 10% penalty on top of including it in your income and including it in your income tax. Right now, under the CARES Act, that 10% penalty is being waived. Now, I have discouraged people before, and I will discourage you again. It is not a great time to be taking money out of your retirement account. It is not a good time to be cashing out of the stock market. The stock market has gone way down, even compared to in January of this year. And if you take out of your retirement account, you're going to probably be taking it out as a loss. However, people got to eat. And so if that is something that you have to do, then the benefit is that there won't be a penalty of 10% on the amount that you withdraw. Also, and this is for small businesses, the payroll tax they have to pay can be deferred for a year and up to 2 years depending upon the amount. What that means is when a small business cuts payroll, all of the individual checks, they have little deductions for various things. That money has been withheld by the employer and then has to be paid to the government. This is often a substantial portion of money for the employer. Under the CARES Act, an employer can defer paying these taxes for a certain period of time. Now, again, I will caution you as a small business employer in doing this, because if you think about it, you're going to be continuing in business, you're going to be continuing to pay wages, so you're going to be continuing to owe payroll taxes. If you defer a present payroll tax payment, it's going to be due at some point down the road. And you're also going to have your continuing business's payroll taxes due. So at some point in time in the future, you're going to be paying double payroll taxes during the same payroll period. And that can be a substantial financial problem. However, yet again, sometimes you got to eat. So if that is a necessary evil, it's there for your benefit. So use it. Finally, let's talk about the fourth area, and that is the loans that the Small Business Administration is giving to small businesses under the CARES Act. Now, there are 2 basic loans that we need to talk about. There is the Paycheck Protection Plan. That is the PPP loan program. There is the EIDL program. That is the Economic Injury and Disaster Loan Program. And people are looking into both of these programs, and they have a lot of questions. And the regulations state that you really can't do both. You can only do one. And so I've received this question a lot. So which one should I apply for? Well, we're going to look at each one side by side. And at the end of it, you're going to see quite clearly which one is the better program. And I'll just tell you up front, the PPP program, the Paycheck Protection Program, is the forgivable loan program, where those loans turn into grants and you don't have to pay them back. The EIDL program is, the bulk of it anyway, must be repaid as a traditional loan. So if you're trying to choose between those two programs, the PPP program is clearly the way to go. So let's talk about each one side by side. Now, the purpose of the Paycheck Protection Program is, of course, to provide paychecks to your employees. So the loan that they give you must be used to pay payroll, to pay benefits like health insurance or vacation pay or retirement benefits. The amount of money received under the PPP program has to be used for these paycheck purposes. At least 75% of it has to be used for these paycheck purposes in order for the loan to be forgiven. Now, the other 25% can be used to pay for certain things like lease expenses and utilities. It cannot be used to pay a mortgage. So if you own the property, you can't use it to pay down your mortgage. However, you can use it for mortgage interest. So it's a little bit nuanced in that way. Compared to the EIDL loan program, that money has to be paid back. Now, there is a portion of that, up to $10,000, that can be forgiven depending upon the specific circumstances and the number of employees that you have. But the bulk of that loan is a traditional loan, and it cannot be or will not be forgiven. When you talk about the amounts or the caps of the loan, the PPP loan program goes up to $10 million, while the EIDL program is limited to $2 million. In addition, the interest rate on the PPP program is only 1%, while you're looking at essentially a 4% interest rate under the EIDL. As I said before, if you comply with the terms of the PPP, it is forgivable. The loan turns into a grant and you don't have to pay it back. However, the EIDL program must be paid back. Now, they give you a term of up to 30 years to do so, depending upon your circumstances. But at the end of the day, this is a traditional loan, and you are going to have to pay it back. Another unique thing about the two loan programs is that your local bank is generally allowing you to apply through them for the PPP program. You have to go straight through the SBA at the federal level to apply for the EIDL program. Another question I get about these two loans is, how much can I get? Now, under the PPP program, there is a formula that they use to determine the amount of the loan that you qualify for. And essentially, they take the amount of your monthly payroll expenses. So they add up all of the wages that you pay, the benefits that you pay, say for retirement, the benefits that you pay, say for health insurance. They total that up for the year, divide it by 12, and then that's your average payroll cost. They then take that figure times 2.5, and that's the loan amount that you qualify for. Essentially, the government is saying, hey, we're going to help you make payroll for 2.5 months. And in exchange for that gift, you are agreeing to maintain the employees that you have, or to at least restore the number of employees and the number that are working full-time by the end of June. And if you do those things, then you can apply for this loan to be forgiven. Now, when you look at the EIDL loan, it can be used for a lot of different things. You can, of course, use it for payroll purposes, but you can use that loan to buy inventory or equipment or other types of things. So in that regard, it's beneficial. But remember, this is a traditional loan that you have to pay back. In regard to the PPP loan, they are really not looking at creditworthiness. They're not looking at whether you have to personally guarantee it. They're not looking at any type of collateral. And that's the benefit of the PPP loan, whereas with the EIDL loan, it is the same creditworthiness standard you'd get from any lender. They want to look at what kind of income you have, what kind of collateral you have, and then they make a determination on the amount that they're going to loan you based upon how they value your creditworthiness. Now, there is some fine print that is in connection with both of these loans. First of all, you can't be in trouble with any federal or state government entity, and that is including on the civil side or on the criminal side. You can't be in the middle of a bankruptcy, for example. You can't be delinquent on any current SBA loan. You must, of course, be an American-based company with less than 500 employees. You also have to be a brick and mortar company. They don't want an internet company that has nothing but a P.O. box participating in these programs. And you also have to keep and provide financial records to support any amounts that you're claiming that went into your payroll cost calculation. And then you have to report, of course, where and how you spent your money to be accountable, to make sure that you did spend the money on approved payroll costs. So those are the 4 areas that you can look into to put money in your pocket today. Thanks for watching, and if you learned something, hit that like button. If you got something to say, comment below. If you're an old person, remember to log in before you comment. If you want to learn more, then subscribe to the channel. And hey, if you've got some friends out there that you think would benefit from this information, share me on social media. Thanks for watching, and I will see you.